Yeah.
All right, good afternoon, everyone. Let's talk about making some money. I mean, generating alpha on Bitcoin. We've got a fantastic lineup for you here today, some of the smartest minds in the Bitcoin investing world. So wanted to introduce and welcome Joshua Frank from the TIE, Walton Comer from XPTO, and Brian Estes from Off the Chain. I guess to get this conversation started, would each of you talk a little bit about what alpha means to you, and how do you guys think about alpha, Bitcoin alpha, benchmarking yourself?
Sure. Yeah, I can get started. I mean, alpha, obviously, you're thinking about outperformance, right? And so, speaking in the context of Bitcoin, it's how can you build a strategy that outperforms Bitcoin, right? So, through active management or active trading or anything else, we're a data and information provider, and so we're not actually, these two guys can speak a lot more about, taking positions in the market. When we work with our clients, it's really how can we provide data and information to help them make more educated, informed decisions. I think we'll get into kind of what that is in a bit, but it's really like, is there news? Is there sentiment data? Is there on-chain data? Is there market? Is there derivatives data? Is there anything out there, beyond just, ARB and other things, which we'll talk about, I think, in a second, that are, starting to dissipate from the market, basically where there are, really opportunities to outperform Bitcoin.
Sure. So for XBTO, we started in market making in 2015. And my co-founder and I were very specific from the beginning to consider Bitcoin the benchmark and the index against which we had to measure ourselves. So we've always been looking to generate alpha against Bitcoin specifically. And while our goal then is essentially a dual mandate to outperform the dollar and outperform Bitcoin. One of those, needless to say, is harder than the other.
So I run Off the Chain Capital. Our whole goal is to outperform Bitcoin and do it with less volatility. So we've been able to outperform Bitcoin 5 out of 5 years with 80% less downside volatility. And the way we do that is that we're a value manager. We use a traditional like Benjamin Graham, Warren Buffett approach and looking for mispriced Bitcoin or mispriced digital assets. And so just using that margin of safety in there helps us create alpha on Bitcoin.
And would like to welcome also Alex Mashinsky from Celsius. Glad you could join us, Alex. We're talking a little bit about Bitcoin Alpha.
Thanks for having me. So we just announced we manage 159,000 Bitcoin. I think it's more than anyone else who was on Nakamoto, right? Paid the community 6,092 Bitcoins. That's probably more than everybody else put together. We invented yield on Bitcoin. 2018, right? We launched Celsius, 1.7 million customers, 23 billion in assets. And the magic is that you get all the performance of Bitcoin, but you don't get dinged. If Bitcoin goes up 5x, you still get the 5x plus 6 to 8% return. And we've been doing it consistently now for almost 5 years. Just stop out the booth 501. Come visit the community. We have an event tonight. So come join us and see what it's all about.
We had a really interesting conversation earlier about kind of both the landscape and the timeline of different alpha strategies. Would you guys maybe kind of kick this off by giving that landscape to our audience and talking about where those different areas of alpha are and where you guys focus as individuals and firms?
Sure. Yeah. So look, I think some on this panel have been in the market trying to outperform Bitcoin for 6, 7, 8 years. So I think they can speak to that well. But look, I think back in the day there was tremendous opportunities on the market making side, for exchanges. Tremendous, opportunities, obviously from an arbitrage point of view. A lot of you guys have probably been in the space for a while. Remember the kimchi premium and the premium in Japan and other countries. And while that still exists, it's definitely, decreasing significantly. I think the best example of that was, I don't know if anybody remembers, CoinMarketCap in 2017 decided on one day to remove the price of Korean assets, and the market cap, on CoinMarketCap dropped by like 15 or 20% because of the premium that existed in Korean markets. And a lot of that inefficiency within the markets, which, in part, that was due to capital constraints on moving money between different countries. But I think a lot of that inefficiency, as more and more sophisticated investors have come in, have decreased, right? The markets are significantly more efficient, and so as a data provider, right? Primarily we're a front end data provider, but we also provide APIs to institutions, right? There are a large number of different data sets that we're providing, and we're starting to see this massive increase in demand for alternative data, right? More than just market data, because as the market matures and becomes more sophisticated, you need to increasingly find alternative sources of alpha, alternative sources of yield, and we're starting to see that with people. The demand, for example, for on-chain data has absolutely exploded. The demand for sentiment, for news, for all these different data sets, and we're starting to see more and more sophisticated factor models where people are plugging in 3, 4, 5 different data sets into a single model to try to predict the movement of Bitcoin. We're starting to see a pretty big explosion in demand for those, but certainly there's still a huge opportunity in market making. There have been a number of traditional funds that have publicly come out. A lot of the largest Chicago, options market makers are market making for crypto, and a lot of them are still market making for exchanges. And there's still opportunities there, but the alpha is definitely, or the opportunities for alpha are decreasing, and you need to find more interesting sources of yield.
So when we got started, we actually looked at Bitcoin and crypto more broadly as the emergence of a new asset class. And for us, what that meant is this was going to behave very similar to what happened when commodities became institutional or when equities went electronic. And having had a background to have been able to witness this, with a pretty good understanding of what styles of strategies would generate the most alpha at different points in time in the life cycle of the emergence of this asset class. So very early on, pure market making, pure arbitrages. Some of the specific examples like these structural premiums and discounts between different domiciles and the price of Bitcoin. Those were very rich sources of opportunity and alpha. And naturally, as more of the structural shops get involved, that becomes a more challenging to go after, just simply because you have more sophisticated parties coming in who specialize in this, and they're very good at what they do. And so after those sorts of strategies, what you really start to see are statistical arbitrages that come in, that emerge, as well as different kinds of carry yield generating strategies like cash and carry, where you will buy a spot position in Bitcoin and then you can sell a future. And those have been very, very good opportunities for alpha over the last few years. But again, as the industry matures, you start to see a decay in the performance of those alphas, and it's very natural. It's actually a good thing because it's a demonstration that this is a rapidly maturing asset class, and the market is becoming very efficient, which is good for individual buyers and sellers, for that matter. Everyone can get in and out at an efficient price. And now what you're starting to see are much more sophisticated types of strategies become important that are. NLP is going to be important going forward. You're starting to see more factor-specific strategies that are designed to be relative value or market neutral. But within Bitcoin, you can still generate alpha within Bitcoin just simply by looking at alternative data sets that might not be Bitcoin specific. And what you will find is that the rest of the asset class can actually be informative. And that's probably where the future of alpha is going to be. And then you have derivative strategies. So simple things like selling covered calls have historically been an interesting source of alpha in a lot of different asset classes. And so we see that also in Bitcoin. So for example, if you were to sell a 1 week 15 delta call and a covered call strategy, I think that's yielding about 30% annualized. None of this is advice, by the way. To be really clear about that.
Yeah, to follow up. Yeah, we're an SEC registered RIA, and I got yelled at my compliance officer a couple days ago when I was on stage. So anything I say is not financial advice. So let me get that out there so I don't get in trouble again. We're one of the largest buyers in the world of Mt. Gox bankruptcy claims. Mm-hmm. So Mt. Gox was the largest custodian of Bitcoin back in 2014. A Russian hacker broke in, stole almost all the Bitcoin. The Japanese trustee was able to recover 141,000 of the Bitcoin that were stolen. So that Bitcoin plus the cash is worth about $10 billion today. So if you had Bitcoin at Mt. Gox, you have a bankruptcy claim on that $10 billion worth of assets. And we buy those assets from people who need liquidity. And it's enabled us over the last 5 years to buy Bitcoin at an 80% discount to what the assets are worth. And so, when I say we're a value manager, that's what I mean. We're trying to buy $1 worth of Bitcoin and blockchain assets for 50 cents or less. Something you guys could do, that Mt. Gox trade's pretty complicated, but if you look at like the Grayscale Bitcoin Trust or Osprey Bitcoin Trust, those are selling at a 25 to 30% discount to NAV today. And so NAV is the amount of Bitcoin that's in those trusts. And you can buy those and get a 25 to 30% discount on Bitcoin by just investing in GBTC or OBTC. And those have been trading at a discount for about a year now, but eventually the SEC will approve those as a spot ETF. And when that happens, the price of the fund will go up to the NAV value. So not only do you get the performance of Bitcoin, but you'll recover that 25 to 30% discount that's in there. And if it's, and the math works really weird. So if something's selling at a 30% discount, you don't go up 30%. You go up 3 over 7, which is 42%. So you don't make 30%, you make 42% in addition to what Bitcoin's on perform once that gets approved. So, but that's something all of you could do, GBTC and OBTC.
Since no one here will give you investment advice, I'll give you investment advice. Very simple, right? No needs for spreadsheets or any special algorithmic calculations or anything else. If you bought some Bitcoin and you can't sleep at night, that means you have too much Bitcoin. You should sell some. And if you bought some Bitcoin, you're sleeping like a baby, that means you need to buy more Bitcoin. Okay, but on a serious note, we have 850 professionals that are doing this job day in, day out, 7 days a week. Our security department is larger than most DeFi projects have in total, right? So you just have to ask yourself, are you going to farm by yourself? Are you going to figure out, for example, yesterday we launched Wrap Bitcoin. So you could take Bitcoin and put it on Polygon. You want to figure out how to do it yourself, or do you want Celsius to do it for you, right? So we consistently beat everybody else on yield, on deployment, on institution. Why? Because we create these new alpha opportunities. We invented this new opportunity of putting Bitcoin on Polygon and earning 12% on it, right? So right now you can't do it with anybody else on the planet. Not even in Polygon you cannot do it, right? So the yield normally, as everybody here said, starts high and then it starts decaying. And only the people who come in early or create the opportunity capture that alpha. The other way to earn alpha is to have the deepest pocket. So when markets are volatile and everybody else is rushing or out of the market, Celsius comes in and deploys its capital and earns 2, 3, 4 times more because no one else has 159,000 Bitcoin to deploy, right? That's when you can charge 20, 30% for Bitcoin because there's nowhere else you can get it, right? So they gave me the whale sign, so I'm probably one of the big whales, but we're a whale that doesn't come out to breathe. You don't see us, right? We're most of the time under the water. We are lending to the exchanges, lending to the institutions, lending to almost every desk in crypto because we have this liquidity. Now, the best part of it is that all of those income, all of the fees that we charge institutions go to all of you. How many Celsians here? Raise your hand. Here we go. So all these people got paid. The rest of you didn't get paid. Okay? You want to get paid? Download the wallet and start earning yield.
So, we've talked a little bit about kind of the history of some of those opportunities, from Mt. Gox to structural arb. Where do you guys think the future of Bitcoin Alpha is? And I'll open this up to anyone on the panel. And also, particularly, if you could kind of touch on, as Alex was alluding to, is the future just for the firms that have hundreds or thousands of engineers working to crank out this little edge, or is there a future of alpha for the everyday pleb?
Yeah, I can start. Look, I think the future is a significantly more sophisticated future. As more and more sophisticated quant funds get involved in the space, and we're seeing that on a day-to-day basis, they're going to deploy into very sophisticated strategies. And I think one very interesting point that you made is the non-Bitcoin data and how that's kind of going to affect the market. And I think there's some, obviously there's really interesting things like, more traditional capital market indicators as well, but we're looking into data sets like web traffic data and seeing how that affects Bitcoin's price, right? So if there's a huge inbound interest in platforms like Celsius or platforms like Coinbase or anything else like that, that's interesting. But looking at like, is web traffic a leading or lagging indicator of price, right? Trying to understand, is sentiment a good or a bad thing? Like these questions aren't that simple, and I think the firms that invest in NLP teams, right, that can do a lot of, we think textual-based data is extraordinarily interesting. So for example, we pull in 7,000 news sources in real time, which are regulatory rulings, SEC filings, court cases, updates from tokens, exchanges, market makers, you name it. And the firms that can react to that information fastest and can build sophisticated learning algorithms that ingest that data, I think will be able to outperform. And I think that's a market that's totally wide open at this point. Like everyone's kind of a genius at a bull market. I like to say, right, when everyone's making money, no one really thinks they need data. When the market starts to consolidate, we're starting to see this massive increase in demand for information. But I think to your question on will retail be able to outperform Bitcoin, I think the answer is still yes, because I think there are firms that will offer yield, and they may be behind the scenes building some of these more sophisticated strategies and market neutral strategies that enable them to offer that to the clients. But I think there will be a few quant funds that are extraordinarily successful.
Just to be clear, finding alpha in Bitcoin is sort of like trying to find alpha in the S&P 500 just by trading it alone. It's probably the holy grail of all quantitative finance problems. This is the most challenging thing that you could possibly want to tackle. There are still opportunities today. They're going to get harder over time. That's just the practical reality of the problem. I mean, this is stuff that normally you have a bunch of quants sitting around in a circle and with hoods over each other's head and a pentagon in the ground chanting something from Harry Potter. I mean, it's a dark art because it requires regime shift detection and other things that are just not it's simply not well understood and may never be. So it's going to get harder, unfortunately. There are still things. There will always be very good tape readers. I think that's never going to go away. So you'll have people who. And many of you may, in fact, be good tape readers who can make short-term trades based on your sort of technical understanding of the dynamics of the market. There will always be people who are good at that, but it rarely scales very well. But for a broader retail audience, that's probably not going anywhere. As are a lot of sort of simple trades that generate a little bit of yield, like simple cash and carry trades, or just buying Bitcoin and lending them to a platform that then does that on your behalf. And then on the institutional side, people are going to increasingly rely on funds that take outside capital and that are structured to handle not just the alpha generation, but the risks that are associated with those. That's why we're actually opening up a fund later this year specifically for that, and we've been expanding our team, preparing to open up what we've been doing for the last 7 years, but to a market that's not just with our own capital. Mm-hmm. But yeah, this is, I don't want people to be naive. Trading Bitcoin is going to get harder and harder and harder over time.
Yeah, so I thought our opportunities would have diminished by now, but they're actually increasing. If you look at the amount of venture capital that was invested in blockchain companies last year, it was $30 billion, which was more than all the previous years combined. And what that tells you is that $30 billion is going in to fund new projects, new companies. And then what we do is to find value is we wait for these projects to become mature. And when those employees at those companies need liquidity, when they need to go buy a house, get married, have a baby, get divorced, or whatever the life event is, we buy that equity from them at a discount. And so, I see over the next 3 to 5 years, there's going to be a lot of those employees who need liquidity. And so that gives us, a tremendous opportunity in the future.
But how do you generate alpha with Bitcoin itself?
Yeah. So
at the Bitcoin conference, if we want to generate alpha from shitcoins and all this, other garbage out there, then there are plenty of opportunities. That's going to be as true as long as there are shitcoins.
As long as he makes money,
generating
it's
it from
all
Bitcoin
good.
itself is
it doesn't matter what kind of money it is. As long as it creates alpha, alpha is alpha. You can buy Bitcoin with alpha. So just to add to this, so we got 750 million out of that 30 billion, so that was nice. We closed it in December. Look, you guys own a 70-vol asset, right? So it's one of the most volatile assets out there, right? More volatile than most stocks or anything else, right? Are you getting paid for that volatility, right? So the best way to generate alpha is to have someone else pay you because you took the risk, right? You're taking the risk of owning Bitcoin for the long term. You're a hodler, right? Can you get somebody to pay you for that volatility? That's what Celsius does. We basically aggregate 1.7 million Bitcoin holders, pool it together, 159,000 Bitcoin. We have the largest pool in the world. And anyone who wants to come and borrow it has to pay yield, has to pay income, pays us, the institution, pay us income, and then we divide all the Satoshis between all of you, right? So you're taking the risk already. If you hold it in Coinbase, they're not paying you for that risk. That's the whole point, right? So you got to get paid for the risk you're taking, for being a hodler, for being a Bitcoiner, and you got to get everybody here on the stage is trying to squeeze that alpha for you. You just have to look at the history, look at the performance, look at do you trust the team? And then you decide, do you hold it yourself? Do you hold the coin yourself? Or do you give it to somebody else to earn yield for you?
Yeah, it's actually a really good point. It's also an ecosystem, right? So when people lend to you, and then you lend to other trading firms, they're out there generating alpha more broadly, and it's coming back upstream, back to Celsius, and then back to you. And
as long as it all stays here, right? If you don't sell your Bitcoin, then we all win. The people who pay are the institutions. How many times in your life institutions paid you fees instead of charging you fees, right? Normally they charge you fees, every inactivity fee, ATM fee, right? Overdraft fee. These are all institutions charging you fees. How many times anyone here charge an institution a fee? That's what we do all day long. I'll take that. Thanks.
So to be clear, you can earn rebates from some trading exchanges.
So do you use leverage to do that, or?
We don't do leverage.
No?
We have an amazing community. On May 21st, on March, when Bitcoin dropped 30, 40, 50%, we had net deposits that day, meaning our community averaged in. They're hodlers. They're like, hey, you giving me Bitcoin at a 30% discount? I'm going to buy more. Celsius had more liquidity. We earned more because we had more coins to lend to more institutions at higher rates, right? Because they already exhausted all the other desks. So when you have deep pockets, right, you get to set the price. You get to dictate. When somebody needs a 10,000 Bitcoin, you tell them, hey, right now markets are volatile 12%. You just charged me 6% yesterday. That was yesterday. Right now the rate is 12%. You're not going to get that 10,000 Bitcoin from anybody else, right? So that's the power you have, but there's no leverage involved. We're not a bank. We can't do fractional reserves or anything like that, right? So there is counterparty risk, right? You have to make sure that you're lending to an institution that has a $1 billion balance sheet. So you know, even if Bitcoin keeps going down, they'll return the coins to you. But besides that, there's no risk of default.
Brian, I know you touched on buying equities a little bit, but a couple areas we haven't talked at all about are venture investing, early stage, or mining. Are those areas where any of you guys see alpha existing still?
So we run a mine and have for 3+ years. So yeah, actually, yes. The answer is that we've been quite pleased with how that's gone over the last few years. And that continues to be an active source of alpha for us. And we've been venture investing since 2017 in companies that are key to the Bitcoin ecosystem, including exchanges, messaging platforms, different services companies, accounting firms, things like this. Some of our best alpha, honestly, is on the venture side. And I think that's, but then again, I think anybody who's been in venture for the last 4 years or plus in the space, if you haven't done incredibly well, I mean, it's.
I have actually one more thing where you can, all of you can do it, right? You can, right now, if you buy a miner and you mine Bitcoin, right? It will cost you about $9,000 to create a Bitcoin on the Bitcoin network as a miner, right? But you need cheap electricity, you need Bitcoin equipment, you need to know where to put it, you need to maintain it. So Celsius bought about 60,000 miners. We're one of the largest miners in North America. And we use that to pay yield to the community, right? We mine Bitcoin, and we blend it with the rest of the income that we have, and you get to participate in that mining operation. We invest about $700 million into mining, and we get Bitcoin 9,000. You get to participate in that cheap Bitcoin because that's part of the yield. Every Monday, you wake up, there's more Bitcoin in your wallet, right? Magic. Yeah, try that with your Bank of America or with your, Goldman Sachs or with anybody else. Those guys are experts at taking money out of your pocket, not putting money in your pocket. So Bitcoin.
I've been looking at mining for 8 years, and I've never found a miner that could outperform Bitcoin. And the main reason
you don't need to outperform it. You just need to buy it at $9,000.
Well, the main reason is that the U.S. government takes 40% of your income when you pay taxes on it. So your after-tax
when you
yield.
When you create Bitcoin and you don't sell it, you don't have that problem at all. The problem you're talking about existed for miners who immediately sold every Bitcoin that they created. But if you hodl, we're a hodler community. Our entire community hodls, hodl, right?
Yeah.
So we don't sell it, we don't have any tax problem.
Well, when you generate Bitcoin, that's a taxable event. You pay 40% income when you generate a Bitcoin for mining.
That's not how it works. But anyway, I have Ernst & Young. If you want to talk to them, I think they're right downstairs. We can talk about that. But look, the point is, do you have Bitcoin? Do you earn yield, right? That's what we're here on stage for. So I'm just mentioning there's one more way, right? You build a Bitcoin factory that makes you Bitcoin, right? You can do the GBTC trade, right? That trades at a discount. You do have to pay 2% annual fee. So if you have to wait 5 years, that's going to eat 10% out of that return that we talked about here before. So you have to take that into account. But there are deals. There are deals to be had out there. You just need to know what they are and you need to decide. Are you going to do it yourself or are you going to trust some of the people here to manage it for you?
I think I can clarify this tax issue. If you're an individual, if you set up an LLC or a corporate, if you set up an entity and you mine through the entity, then you're going to be taxed on your net income. If you're doing it individually and you haven't gone through that step, you could find yourself in a pickle.
Well, I want to add something super quick on the venture side and the outperformance and the alpha side. We see a lot of fund managers that have these unbelievable track records, like 24,000%, 2,400%, whatever, but they happen to have bought, I can't name the altcoins, but particular, 1 or 2 or 3 positions that led to this, massive, incredible outperformance. And I think something that's interesting to monitor and interesting to watch is, the track record of these fund managers over time and understanding, how are they actually managing their risk? I mean, I don't think, the idea with a hedge fund is that you're supposed to hedge your risk. I mean, that was the concept behind hedge fund, and how many of these funds are actually hedging their risk is a question that we ask all the time. But I think it's important to understand whenever we look at funds, it's like, what is your benchmark, right? Are you benchmarking Bitcoin? Because, to the point that I think a couple of you guys made earlier is like a lot of people have actually underperformed Bitcoin in the long haul. And if you're benchmarking the US dollar, I mean, that just doesn't make any sense unless you're building like a market neutral strategy. Like, I don't think you can operate a crypto fund without at least, I think the benchmark should be the overall performance of the entire crypto universe, but without at least a benchmark of Bitcoin, because most of these, or a large swath of the funds that have done very well with like 3 positions.
I'll give you an example of how you could outperform Bitcoin with equities. So a year and a half ago, Coinbase was looking to go public. JP Morgan and Citigroup were in talks to buy Coinbase pre-IPO at a $25 billion valuation. Goldman Sachs stepped in, said they would underwrite Coinbase at a $30 billion baseline. And so if Coinbase is worth $30 billion, then Kraken, which is the second largest exchange in the US, should be worth about $10 billion based on revenue and earnings. We were finding employees at Kraken who were willing to sell us Kraken shares at a $1 billion valuation, even though it should be worth 10. The reason we were able to get a $1 billion valuation is because they just didn't know. They didn't know what Coinbase was worth. And so we were buying between a $1 and $2 billion valuation a year and a half ago. Kraken today trades very consistently at a $12 to $15 billion valuation in secondary stock markets. So we made 10 times our money in 18 months, in which outperformed Bitcoin. So there are ways to outperform Bitcoin in equity markets.
We're getting into the good stuff, but unfortunately we have been cut off. That's all we have time for. But please, let's give these guys a round of applause.